Hey, good morning, everybody. Good morning.
Good morning, Professor.
Hey, good morning, Jason. You are loud and clear this morning, right? How
Yeah,
about everybody else? Huh? How about everybody else? I see 12 people currently in the collaborate,
I
and
don't know.
hmm.
I don't know if I told you. I'm still having issues with McGraw Hill.
So yeah, I replied to your email, and
Yes,
I gave you the
the
contact
contact
information of.
number. I will get in touch with that person as soon
Okay.
as class is over.
Yeah, yeah. I mean, it's just email. And you don't. And I also provided her,
Her
uh,
contact.
yeah, yeah, phone number as well. So don't wait for the don't wait to. I mean, you can call anytime, but I mean, sending email. You can send email, like even Sunday night. I mean, she
All right,
will
I
she
didn't.
will find the email Monday morning, or respond at her first chance.
All right, I didn't know I can do that for
Why not?
weekdays.
Why not? I mean, email is the most basic form of communication these days.
All
I
right,
mean, you can,
got it.
mhm. Yeah, and I'm just uh, I'm just wondering because in one of your emails you said you canceled the order and then you would purchase the. I thought you already purchased the ebook.
No, I haven't purchased the ebook yet.
Yeah, yeah,
I
okay.
was
So
using.
that was my understanding. I thought you already purchased after canceling the physical book order. Then I thought you
Yeah,
purchased the ebook.
I tried going back to purchase it, and what happened is it was no longer available
What do you mean
on my
the
phone.
ebook? You mean
Yes.
the ebook? No, no, no. Ebook is look. There's no reason ebook isn't available. Ebook is
Okay.
just ebook is just a like um, your access code to access all their online platform,
Right.
all
All
their
right.
online materials. So it's unlimited, right? There will be
Mhm.
unlimited number of ebooks there because it's not physical, right?
Right.
It's only digital, and you cannot delay this. You cannot delay this
Any further?
much
No.
longer because
No, I'm not.
things have piled. I mean, think about all those things that you have missed and that have piled up. You cannot just and you cannot just make up just one day or overnight. I'm just concerned. A lot of people, if a lot, have that baseless belief that they can make up just on one day. No, it's everything is cumulative, and if it is cumulative, if you just let it pile up, you can't solve it. You can't solve it in just one single day. Okay, and our
Yes.
final is only 25%. I mean, think about it. Before you must do everything on time, right? When they are due, right? You must do everything on time at the time they are, you know, made available because you can't make up all of that. And just don't hope that, just don't hope that you can make up everything, on one final day. No, it's impossible. If you have missed 25%, if you have missed 75% of class so far, then that 75% cannot be made up on one day, right?
Right.
So
Jason,
please,
Jason,
yeah,
Yeah.
please
did
get.
you, Jason, did you buy the book yet? I mean,
No, I
did your
haven't got the.
stuff expire?
It expired. Yes.
Okay, so when you go and log in, right? it's going to say your access to this class has expired. Then after that, you press the blue button, renew access on the website. After you press renew access, right?
Right.
It's gonna send you these 4 options. And don't rent it, because you're never gonna get the book. You're gonna use Connect code. You're gonna buy the Connect digital code. You're gonna buy it. It says Connect full digital experience with discounted loose leaf textbook available after registration. That's what you're gonna buy. You're gonna press buy it, and then there's 2 options: a $50 option and a $130 option. And you pick the $50 option because that's only for this semester, and it's gonna have access until January, February, March, until April 16th. So
Okay.
log in. It's gonna say your
Yes.
stuff expired. Press redo, then buy, and then buy the code. After you buy the code, you're gonna have access until next year. Do not call
All
them.
right.
Do not buy the book, and do not buy the loose leaf textbook. Okay?
All right.
Just renew the
Thank you.
access. Yeah, no problem. Do not buy the book.
All right.
All
Thank you,
right.
Alyssa, for
Thank
the
you.
input. Yeah,
Thank
those
you,
are things
Alyssa.
that
No problem.
that's the kind of information that only students would know. I would never know because I won't have to click the trial access or anything like that. Um, well, anyway, so I see 14 people in the discussion board, and I see 15 here. So that means at least one person here hasn't signed up in the today's discussion board. So please don't forget to sign up sign into today's discussion board, because that's the only proof of your physical proof of your attendance to validate your attendance. All right, and right, section 1400. Okay. I believe we talked about the last thing we talked about was the balance sheet, right? And I don't want us to be dragging on with the financial statements, but it's important because fundamental analysis, when they say fundamental analysis, and fundamental is used in basically when they say financial fundamentals, right? And fundamentals I'm talking about is financial fundamentals. Financial fundamentals are based on the balance sheet and income statement, and everything, the data from income statement and the balance sheet are really the fundamental basis for evaluating a firm. And as I said, the reason we are talking about the financial statements is because this is a microeconomics perspective of ROI, return on investment. I mean, the first topic, return on investment, was the macroeconomic perspective. I mean, from the macroeconomics, what is ROI? Of course, the basic formula for holding period return, it doesn't matter. It's basically transcending, transcends. It transcends both microeconomics and macroeconomics, because it's the basic definition. Holding period return, which is price at time t plus 1, t plus n minus price at time t plus the income, right, during that period, right, divided by price at time t. I mean, what else can it be? That's the only way we can define the return. I keep talking without any. Let me, but first, let me just quickly check what was our last discussion about. October 13th. Okay. In October. On the side of the seller, the Dell, right? It's an opportunity cost. 10% is the opportunity cost to that, right? And the opportunity cost is, but if they don't have to wait 3 months. The point is, if they wait, that's fine. But let's say I've been telling you, all business, especially small businesses, are constantly 60. They have held it until then. Why? Okay, so it was, we were basically talking about the promissory notes. But again, I just want to clarify that I was just talking about the basic concept of holding period return, right? PT plus N minus PT, right? I mean, just to bring back. So what the basically, this is basically ROI, right? It's basically, how we define return on investment, or cash flow during that time period. And so whether we look at return on investment from macroeconomic perspective or microeconomic perspective, basically, I'm using, basically this is the definition, right, that we have to keep in mind, because this is what we are return on investment is. This is what we are after. And in macroeconomic perspective, we cannot ignore the importance of interest rate, right? Which is the most basic form of return on investment. And then in microeconomics, right? In microeconomics, from micro perspective, right? How does the firm perceive the return? I mean, how does the firm see the return as? What does it see return as? Of course, return on investment, from microeconomics perspective, is basically based on profit, right? Because profit is basically, and then from microeconomics perspective, profit is not rate, right? Profit is dollar value, right? So in terms of rate, right? From the company's perspective, return on investment can be defined as return on equity and return on assets. Okay, and then they are basically return on equity is profit over equity, right? And simply defined. And return on assets, now it's also roughly defined as profit over total assets. But then this profit, the pi, right? The symbol pi, I've been telling you, it's the symbol for profit. The Greek character pi is Roman alphabet P. So what else can it mean? It's profit, right? Although in macro context, macroeconomic context, pi is also used as the symbol for inflation, but in microeconomics context, there's profit. But when we say return on equity, it's actually EAT, right? The net profit. Whereas the profit in return on assets is actually EBIT, right? EBIT, the operating profit over total assets. So, but the bottom line is, think about it. EAT earnings. Okay, I'm not gonna. Now you might wonder. It doesn't look like this. It doesn't look like, where is then PT plus N and where is PT? Well, net we don't find net profit that way, because net profit is the result of income minus expenses minus interest and taxes, right? So it cannot like there's no parallel expression like that. But the bottom line is, still this is the EAT is the oh, why is it? EAT, if you think about it, it is the difference in the equity between time 0 and time 1, right? EAT is the difference between equity at time 0 and time 1. Now, think about it. If I let me take you back to not this one. Where is my, not this one. And then there was this one. Yeah. Now, I've been telling you in this, fundamental analysis, right? Or in other words, in the analysis of financial statements, we need basically 2 balance sheets and 1 income statement, right? Why 2 balance sheets? It's basically balance sheet at time 0 and balance sheet at time 1. Balance sheet at time 0 is always, if 1 year, right? We need to compare one year, 2000, say like 2019 balance sheet and 2020 balance sheet. We need to have these 2, because that will tell us how much things have changed over 1 year period. Isn't that right? So time zero, if time zero is end of 2019, time one will be end of 2020, right? And then also end of 2019 is the same thing as beginning of 2020, right? And that's something we have been, I have made it, that's something that I have made clear from the day one. So, so time zero means, still the same thing. Time zero is like the end of 2019, as well as the beginning of 2020. And time one will be the end of 2020, which is the same thing as the beginning of 2021. But either way, we need to have two, it doesn't change, we need to have two balance sheets, at time zero and time one. And then income statement is already the income statement at time one, right? Because our operating activity, right? I've been telling you, income statement is basically explaining or describing the operating activity for the year. And we are assuming the operating period is 1 year, because I've been telling you the basic operating period or operating cycle is quarterly. But, rather than comparing quarter to quarter, let's say we are comparing year to year. So as we look at the income statement, this profit or loss is basically, the result of operating for 1 year. Isn't that right? So this is, EAT at time one, in other words, right? So here, if I put a time subscript, right? If I put a time subscript, right, time one, right? And then equity as of time zero, right? Because equity and also total assets as of time zero. Now let's think about it. The return on equity and return on assets are basically return on equity and return on assets are basically the ratios that belong to the category of ratios called, profitability ratios, right? I'm not going to talk about the ratio analysis at this point, because it's going to take us. That's going to be another thing, and it will take at least 6 hours to fully explain that. But ratio analysis will be discussed in more detail in Finance 230 and also in Business 210. So I'm not gonna go into that in Finance 100. But what are these ratios about? These ratios are, if you think about it, they measure profitability, right? The profitability of the company. But also, in a way, if you think about it, it's like a productivity, measure of productivity, or measure of efficiency, right? And if you think about it, productivity is obviously there's a wide spectrum of productivity. I mean, there's low productivity and there is a high productivity. But when we say efficiency, right? Efficiency means high productivity, right? Obviously, low productivity cannot be considered efficient, right? And what is a productivity? I mean, to put it in a simple way, it's output to input ratio, right? It's output to input ratio. Now, which means, let take the gas mileage for instance. Gas mileage is a very good example of output to input ratio or measure of efficiency. Isn't that right? Now, if someone says, and if you have a car, you would be very, you would be quite concerned about the fuel efficiency or fuel economy of the car, because nobody wants to drive a car that consumes 10 gallons but just gets 1 mile. Huh? If you have to burn 10 gallons of gas just to get 1 mile, that's a tank, right? That must be a 72-ton tank. And right, even a 72-ton tank should get a better mileage on. I mean, if you or a jet fighter, like maybe jet fighter would have lower. I mean, they would have to. A jet fighter is even faster, right? Very fast. So you would get for burning 1 gallon of gas, you could probably get 100 miles on, right? But the point is, you get the idea. Nobody, everybody understands what gas mileage is. And if you think about it, it's the most basic form of output to input ratio. Why? Gas mileage, the structure of gas mileage, look at the construct of gas mileage. It's basically, how many miles? For number of gallons, right? So if your fuel tank, the fuel tank of your car holds 20 gallons, right? So you fill up, the tank, drive until you run out of gas, right? And think about it. And if you got 600 miles, right, for those 20 gallons, right? Your gas mileage is 30 miles per gallon, right? 30 miles per gallon. And 30 miles per gallon is not that bad. I mean, actually, in reality, I mean, if you have a gas guzzler, like, 8-cylinder, 5-liter engine, 8-cylinder, 5-liter engine, or, something like, Cadillac Escalade, or, those big SUVs, they won't even get 30 miles per gallon. They will get at best 20 miles per gallon. They are gas guzzlers. I mean, even on the highway, right? And in this day and age, where, we are, every country, every nation is trying to lower the, carbon emission. Driving a car like that, and you are only one person, and you drive, one person in that Humvee or Cadillac Escalade or Ford Expedition, one person, and you just drive just about 1 mile. That's all per day. I mean, you leave, from your work. You live just 1 mile away from work, and you just, drive that Humvee every day, or Ford Expedition every day, right? Wasting gas, like, getting, 10 miles per gallon only. That's just, not only bad for the environment, but, and then you complain, I only eat, I only eat carrots. Why am I getting weight? Why am I getting, I never lose weight. You sign up for this, gym, and you go to the gym after work, but, you drive. The gym is only, let's say, 1 mile away from your work, or 1 mile away from your home. You still drive that, in that, big SUV that gets very low gas mileage, right? And then, I mean, instead of paying for the gym, if you just walk from home to work, and walk from work to gym, and walk from gym to home, right? At least you walk 3 miles per day, right? But this is basically how people live these days. I kind of digressed a little, but you get the idea. So gas mileage is a typical example, and you understand. This is the output, right? The miles. That's the output, and this is the input. Isn't that right? And think about it. The higher, so output-input ratio is indisputably the best measure of efficiency, right? Also, it's productivity, right? Everybody, gas mileage is also called fuel economy. Why? Because economy is about, efficiency, right? So the same idea, if you think about it, from the company's perspective, right? Net profit is the output of the equity. I mean, of course, output, it's the ultimate output of the total assets. Why? Total assets are what? If you think about it, I've been telling you, assets must generate income, right? Assets must have income generating capability. Otherwise, it has zero asset value. I've been telling you. Did I give you that? Did I give you that? 100 square feet example, 100 square feet of land in Midtown Manhattan. Did I give you that example? I mean, if you have 100 square feet of land in Midtown Manhattan, and if it is just idling, I mean, think about it. Midtown Manhattan, 100 square feet. It's a prime real estate, prime location, but it's an empty lot. Now, it has a potential, right? Revenue generating, income generating potential. But as long as it's just idling, just an empty lot, idling empty lot, then it's it's a non-performing asset. It has zero asset value, right? Whereas if you park even cars there, I mean, 100 square feet is not a big space, because it's just 10 feet by 10 feet. That's 100 square feet, isn't that right? 10 feet by 10 feet. And how many cars can fit in that 10 feet by 10 feet? Maybe you can park 3 minis, right? Maybe you can park 3 minis. But even parking 3 minis, it generates income. right? And if you build a parking structure, like 20-story parking structure, at least you can park, 60 minis in that parking structure. Then it has a huge, income potential. I mean, in Midtown Manhattan, parking is like what? $40 an hour? I don't know, $20 an hour, right? So, look, assets, and I've been telling you, assets exist to generate income. A company is nothing but a vessel, isn't it right? Company is nothing but a vessel to generate income for the owners, right? Who are shareholders, right? And then the owners are the equity holders, right? Owners are the equity holders, right? Stockholders, right? So from owners' perspective, they want to know how productive their equity was, right? How productive or how efficient their equity was. And the net profit or earnings after taxes, is the output of their input. Make sense? Their input is the equity at time 0, and their output is the net profit at time 1. Right? Does that make sense? Now, again, equity is only one component of the total assets, right? Isn't that right? I told you last time that and you should remember this. I mean, if you don't remember this, that's a betrayal, right? Betrayal of my faith in you. I've been telling you that the balance sheet, the goal of the balance sheet is, or the purpose of the balance sheet is to explain or describe the capital structure, right? Capital structure means, how much of the total assets came from equity and how much of it came from debt. And in our example, the capital structure is 60% debt, 40% equity, right? And I told you this is not a very good capital structure because if your total assets came, 60% of your total assets came from debt, then the company will be heavily burdened, with the under heavy burden of debt servicing. In other words, you have to pay interest on it, and because your total assets, 60% of your total assets is debt, and sometimes you have to pay principal, right? And I must have also mentioned this. If your debt is mostly bonds, you don't have to pay principal back until maturity. You understand already because we talked about the bond in topic 1. Bond, if you sold bonds, you only have to pay interest until maturity, and at maturity you pay the final interest and the face value, or the maturity value, right? The face value, which is the principal, right? But bond has less burden, right? Until maturity. And you might wonder, but then at maturity you have to cough up the entire principal. So isn't it a bigger burden? If it is not spread over, the life of the bond, Yeah, well, most companies, I mean, theoretically, yes, you have to cough up. I mean, if the company has sold, $10 million worth of bonds, they only pay interest until, and if the maturity is 10 years, for 10 years, they will just pay interest. And at the end of year 10, then they will have to cough up 10 million, right? Out of their own pocket, in theory, but in reality, they don't do that. They can simply think about it. They can only pay interest for 10 years, but at the year 10, what they can do is they can sell new bonds for 10 million for new round of bonds, right? New round of bonds for 10 million. So the proceeds, with the proceeds from sale of new bonds, they can pay off the old bondholders, right? In other words, they can roll over. They can roll over the 10 million as many times as many times as they can. They can roll over, right? It's like refinancing. So bond has, that's the reason why they use the bond market, right? Has many advantages over just straight loan from a bank. If it is a straight loan from a bank, then you amortize it. Amortization, if you amortize it, the difference is, in case of bond, you pay only the interest, but in amortization, every month or in every installment, it can be monthly or it can be quarterly, it can be annual, but in every installment, and the monthly installments are all every that periodic installments are all the same in the amount, right? I mean, if any one of you have a mortgage, you would know. Of course, not most of you won't have any mortgage because that means you have a house. Maybe but maybe you've heard of your parents talking about mortgage payment, and mortgage payment, monthly payment. It's always this, same amount, but that same amount, monthly installment, right, consists of both principal and partial principal and interest, and it's not in same proportion every time. It's not in same proportion. For early on, the largest chunk is the interest, right? And that means, if the monthly mortgage payment is $3,000, about $2,500 is interest in the first month, and then in the second month, and gradually the interest gets smaller. That means in the first month, principal is only $500, but gradually principal gets bigger and bigger and bigger. Okay, this is amortization. This and you will learn about that in topic 3. We are almost, actually, by the main lecture, we are already there. But the bottom line is, whether you have 40% equity and 60% debt, as in this case, or whether you have 70% equity, 30% debt, which is more, normal, your total assets, think about it. In this example, your total assets are mostly plant and equipment. Your assets are mostly plant and equipment, right? Out of $10 million assets, almost, 9.5 million is fixed assets, the plant and equipment, right? You might say, oh, that's not 9.5, 9.34. That's after depreciation, but before depreciation, there was 9.5 million, right? 95% of the total assets was all in plant and equipment. Plant and equipment is the means of production. I've been telling you. Physical capital, I mean, the meaning of the word capital is means of production. There is money capital and there are physical capital, but before splitting into money capital and physical capital, the basic definition of capital is the means of production, right? It's like, Karl Marx, right? But there's no denying whether it is Karl Marx or not. Capital is means of production, and company is only a vessel. The company utilizes the means of production to generate income and pass it on to the shareholders, right? And then these assets came from liabilities and equity. I've been telling you, so liabilities and equity is the source of capital, right? Asset side is only showing how, in what form the capital that was raised is held, right? In what form they are held. So that means total assets. Total assets is the similar concept as physical capital. Of course, total assets is not exactly capital because there's non-physical assets like current assets. But since in this example, 95% of the total assets is physical capital, right? Physical assets. Total assets is basically the input, right? The output is the result of the workings of the input, right? So the bottom line of today's lecture is that this, if you think about it, return on assets, you understand why the input is the total assets, and the outcome or the output of the total assets is the operating profit or EBIT. Why EBIT? Well, because why not EAT? Why not earnings after taxes? Well, because earnings after taxes belongs only to the owners, right? And EBIT owners or the equity holders, right? But total assets doesn't include only, total assets is not only equity, right? Total assets include equity and debt, right? You understand? In our example, debt was actually 60% of the total assets, right? Think about it. Then there is nothing that belongs here, in earnings after taxes, right? In net profit. There's nothing in net profit that goes to the debt holders. To the debt holders, EBIT is a better measure of the output because to the debt holders, interest is their fruit, right? Interest is their fruit, right? That makes sense for the debt holders. So that's why we have to use, operating profit, right, as the output of the total assets. Okay, so these are two measures of representative measures of return on investment from the company's perspective. Of course, there are more return on there's return on capital. That means capital means long-term capital, right? Short-term capital, like short-term debt is not. It's not short-term debt is not even called capital. Okay, short-term debt. like current liabilities are not even capital. They are not capital, right? Current liabilities are not. Return on capital is only long-term capital components like debt, long-term debt, and equity. And there's also return on sale, right? But we're not gonna talk about that because these are two representative return on equity and return on assets are two representative ratios for return from the company's perspective. Okay, now I didn't go into detail about accounts receivable, but it's all in the main lecture. If you have watched the main lecture, and even if it is not available anymore on the Blackboard, it's available on YouTube. You must, so I'm not going to go over that again. Why it's called factoring and etc. etc. And also, I hope if next Wednesday we have 2 hours, so I will have to talk more about earnings, the relationship between EAT and earnings per share and how that has to do with book value per share and all right, so that's it for today. We're already out of time, like 5 minutes past. So you guys owe me 5 minutes next time. So any questions? Any questions so far? Any questions? All right. If you don't have any more questions, then I will stop sharing and stop recording and sign out.
Sure, Professor.
All right, you too, Jordan. Have a good afternoon, everyone.
Bye,
Take
Professor.
care. Oh, all righty, Natalie. All righty. Take care, everyone. I'll sign out.